investment in foreign operations. This is another question, slightly more complicated than the ones that we've been solving in the past. Take a few minutes, go through the questions, and we'll solve it right away. So look at this Gull PLC, planning to have a factory, which will be leased for 5 years in France. The company is based in the UK, so we've been given the annual lease, which will be 3.8 every year, paid in advance. This one, I'm spending a lot of time now to explain this part to you now before I go into the Excel part. You see, anytime you have an expense, be it tax, be it lease, whatever expense that you know has impact on taxation that is not accounted for or that is not paid in the same year it is incurred, you have to be careful. Because remember, for taxation, cash flow does not matter. Expenses must be recognized in the year they are incurred. So when you are computing your profit after tax, you must account for all expenditure in the year they are incurred, regardless of when they are being paid. When you finish your profit after tax, you can make all the adjustments to those cash flows that are not happening in the same year that they are being incurred. So you can take them out and now bring them in the year they have been paid or received. So remember, the first thing you want to do is to estimate your profit after tax in the foreign operation. So the year cash is being paid will not be mattered. Right? So please pay attention to that, and I'm going to solve that in this question. So let's go into the format year 0 to year 5. This time around, if you have gone through the question, you realize that we're going to have year 6 because in the UK, taxes are paid in arrears. So something is going to spill to year 6 at a point. So stay tuned. The first thing I always like to do is to calculate the exchange rate because we will always need our exchange rate. Yeah. And that will be euro over pounds. Yeah, the spot has been given to be 1.5, as you can see. So we have 1.5 as spot. And we have inflation in the UK to be 4%. Inflation in France has also been given to be 6%. So we're going to use purchasing power parity to calculate the forward rate, and that is spot multiplied by 1 plus inflation in the first currency. Here the first currency is euro, and that is 6%. So I can just say 1.06 to save time, then divided by 1.04. That's 1 plus inflation rate in the UK. So we have our inflation for year 1, year 2, year 3, and that's exchange rate. All of that, we got it. Very important. Please take notes, see, look at how we're dealing with it. So we have all our exchange rates from year 1 to from year 0 to year 6. So we can start with revenue. So we need to project revenue. They've told us that the price is going to be 750. You can see it here per window. For year 1, it's going to be 50,000 units of windows that will be sold. So I'll work in millions. So I'll do 50 multiply by the price of 750 divided by 1,000. So it can be in millions. I want to work in millions. Yeah, please. I'm working in millions. So take notes. And they also told us about inflation, that is 6% in France. So we know that we need to multiply that by inflation rate, and that's 1.06. Yeah, raised to power 1. So that gives us the revenue for year 1. We need to do for year 2 up to year 5. So from year 2 going forward, the unit is 80,000, and inflation for year 2 here. We need to increase those inflation years. So this will be year 3, and this will be year 4. And this is year 5. So we have the revenue projected. The next thing is to think about the operating cost, which has been told that the cost is 150% markup. Yeah, so 150% markup. What does that mean? What is the relation between markup and revenue? I can quickly show you. Let me say this is working 1. So it's easy, something you learned during your management accounting days. But let's do a quick refresh on that. Yeah, so operating costs, remember that your markup is equals to profit divided by cost, the operating cost, right? So which means that we know that markup is 1.5. They told us 150%, so that's 1.5. So which means we know profit will be equals to 1.5 times cost, so that's 1.5 cost. Cost is what we are looking for. And something we know for sure is that profit is also the same thing as selling price minus cost. So profit is cost to selling price, or revenue minus cost. So which means if we substitute the two equations together, it means that the 1.5 cost, which is our profit, is equal to revenue minus cost. So 1.5 cost, yeah, this is bringing this part. Yeah, because profit is the same thing as 1.5 cost. So that means 1.5 cost is equal to revenue minus cost. And if you bring this minus cost into the other side, it becomes positive. So which means 2.5 cost is equal to revenue. That means that we can always get our cost to be equal to revenue divided by 2.5. So that's what I'm going to be using to determine the cost. So which means the operating cost, which is cash outflow, is equal to revenue divided by 2.5. And that's how we get our operating cost for all the 5 years. And I hope that is very clear. Now, we know that they told us about the lease, which I mentioned, lease renter. Though it's paid in advance, but we're not dealing with cash flow seriously now. We want to get our profit after tax. So we're just going to account for that 3.8. Yeah, in the year it's incurred, year 1 to year 5. We got that sorted. They also mentioned to us that there is a tax depreciation that's on a straight line at 25%. So that means depreciation policy is 4 years. So tax depreciation, 75 divided by 75 times 0.25, 25%, yeah. So every year there will be that depreciation, but it's going to be 4 years, yeah, because it's 25%. 25% is 4 years, right? So that at the end of 4 years, the whole asset is fully depreciated. It's a straight line method. Royalty is the next one in the questions, as you can see. We need to deal with royalty because they told us that the French subsidiaries will pay this fixed royalty of £20 per window. And that's an expense, so that will be cash outflow as well. But that is in pounds, so which means we need to convert it to the euro, which is the foreign currency. So, and how do we do that? We know that 1.53 euro is equals to £1. So that means we need to multiply this exchange rate by 20 million. The 20 per window. So number of windows in year 1 is 50,000. So I'm going to divide that by 1,000 because we're working in millions. Yeah, it's going to be outflow because it's expense. Yeah, and that will be applicable to all the 5 years, but this time around we're going to have 80 because 80,000 units of windows you start selling from year 2 going forward. Okay. making good progress. They told us in the last paragraph as well that the asset will be sold at the end of the year for 70 million euros. So for an asset that has a book value of 0, there is a profit on disposal. Yeah, so there's a profit of disposal of 70 on that asset. So with all of this, we can know that our taxable income in foreign currency, in euro, is equals to, when we add all of that together, so from year 0 to year 6, we've got our taxable income. I hope it's looking pretty easy. So once we have our taxable income, then we can calculate the foreign tax. So taxation in euro is paid at, I'll be minus 40%. So multiply by the taxable income. We've got our taxes, and we can now get our profit after tax in euro. Remember, payments in arrears or in advance would not matter here in this first part. If there is any of such, this is time to make the adjustment now. After we've gotten the profit after tax in euro, then we can make all the adjustment. When we finish making all the adjustment, we have the real cash flows in foreign currency. Then we can now convert it into pounds. But we are not going to convert until we make adjustment, because this profit after tax is not cash flows. And in management, finance management, we deal with cash flow. So we need to make adjustments. So let's make all the necessary adjustments now. So all the non-cash flow items, the first one we need to add back is our tax depreciation, because that is not a cash flow item. So we're going to add back the tax depreciation because we've deducted it before. Likewise, we realized that there was a rental expense that was accounted for in accounting way. However, in cash way, it is not meant to be this way, because it is actually paid in advance, which means year 1 cash flow was not paid in December, was paid in January. And that means in finance management, 1st of January is the same thing as 31st of December of the previous year. So we need, first of all, correct that. So reverse the lease or the renter. So we need to take it out, what was done before, and do it the proper way. So we've taken it out. Now we need to account for it in the way it's been paid. So lease cash flow now. So lease cash flow means that it's paid in advance, 3.8 year 0, then the last one will be paid in year 4. Please follow on closely. Likewise, this profit on disposal is not a cash flow. We need to adjust for that profit and bring in the real cash flow. So I'm going to deduct the profit, take it away from the profit after tax. I mean, for this one, it looks like it's simple, it's same figure that is cash, but in some questions might not be the same. So get used to this format. So deduct profit on disposal. So I'm going to take it away, and I'm going to bring in the cash flow on disposal, which is the same figure. Right. Nicely done. With this, we can now check what our total cash flows will be. Yeah, so trading cash flow in foreign operations. Before we account for the balance sheet items, let's find out what we got. So we're going to have the profit after tax here with all the adjustments that we've made. So we have trading cash flows in euro. So we've got our trading cash flows in euro. Now we can add the statement of financial position items, starting from the initial outlay. They already told us that only 60 will be paid in the beginning of the project out of the 75. The balance will be after 1 year, 12 months later. So which means here we have 60. And after we're going to have a 15. They also mentioned that there's a working capital requirement here, this paragraph. Yeah, so we need to account for this working capital that is required beginning of every year at 40% of revenue. So we need to do working capital. So let's say working 3. Okay, we don't have so much working, so we can actually do working 2 for that. So let's call it working 2. So let's do working 2, working 2. So for working 2, that's where we need to estimate what our working capital will be for each year. We know that 40%, so I'll say required start of the year. So year 0 is now, so year 1, start of year 1, how much working capital do we need? We need 40% of the revenue in year 1, which is this. So we're going to multiply 0.4 by that revenue. And that's what we're going to have from year 1 to year 5. But we need to get the cash flow implications. That's what we need, not what is required. What is the cash flow implications? So for cash flow implications, if we need 15.9 in year 1 at the beginning of the year, means that we must have bought it end of year 0. So to calculate that, so which means the cash flow impact will be this, and will go like that for each of the years until year 5, when the whole of the working capital left will be recovered. Please take note, always remember to recover the balance of your working capital. You can see you're lucky, question even stated it clearly here. Sometimes they might not tell you, but you need to know that at the end of the project, the working capital will be sold. It's just like inventory. Okay? So that needs to come into our cash flow projection, because working capital is also a cash flow item. So working capital requirement, year 0, I'm just going to link it to the workings. So the workings, yeah, good. Then drag it for year 1 to year 5. After that, we can close out on the cash flow in euro. So cash flow in euro, total cash flow in euro will just be addition of the trading cash flow and the balance sheet cash flow. So this is trading cash flow and this is a balance sheet. So we have that for year 0 and all the way down to year 6. Everything is there. Looks easy. Now we can now convert this cash flow to pounds so that we can make ordinary pounds adjustment as well. So all we need to do is to use our exchange rate, which we already have it here. So if 1.5 euro is 1 pound, all we need to do is to divide this by the exchange rate and we'll get the amount in pounds. So look at this, that's it in pounds all the way down. Please take your time, look at it. If you have any confusion, I'm ready to explain to you. Put your comment, reach out to me. Don't make any assumptions. It's good to be very comfortable with these workings, and you need to also practice a lot on your own. Now let's make adjustment in the parent company, which is adjustment in UK, GBP. The first adjustment that comes to your mind is the royalty that they collect. This £20 per window is an income to the parent, and they will also pay tax on it. So royalty every year, so that will be 20. Remember, it's 20 per window, so times 50,000. Yeah, remember, I'm working in millions. So that's for year 1 all the way to year 6. Year 5, rather, there's no royalty in year 6. But 80,000 is what is sold after year 1. So take notes. Don't make mistake. All right. So we need to pay tax. Definitely. There'll be tax because you can't make income and not pay tax. So there'll be UK tax on royalty. This question is slightly different from the previous one because there is no excess tax from the UK operation. I'm sure you know why. The reason is because UK tax is at 35%, whereas the foreign country is actually at 40%. So the subsidiary is already paying more tax than the parent. So there is no extra tax to be paid. But for this royalty income, definitely UK will need to pay tax on it. And they'll be paying tax on it in arrears. Please take note. Tax in arrears. So which means 0.35 is cash outflow, so 0.35 multiplied by this. And that will be happening until year 6. Quickly, something came to my mind now that I need to quickly touch on, and that is here, taxable income here. Yeah, please be careful. There's an oversight here. Remember, the question told us that if there is a loss, let's look for it, that the loss is carried forward. You cannot pay tax when you are making loss. So we need to take that into consideration. Yeah. So look at this. Unused loss should be brought forward to set off against the following year's profit. So which means this taxable income is a loss here. So we shouldn't be paying tax here. So this should be 0. There shouldn't be tax here. And the tax we'll be paying here will be set off first with the next year profit before we pay the tax. So I just need to quickly correct that. Please take note. And that shows how careful you have to be, because you can see even as I'm doing this with you, I also make mistakes. So now think about you, how much mistakes you will make as you try to practice on your own. So it's very important that you practice this thing and don't take it for granted at all, please. Yeah. So let's just be sure that that taxable income is correct. So now that we know the cash flow in GBP, the adjustment also in the parent company, we've done that. There is no further adjustment to be done. Then we can get the total cash flow in GBP before we do the discounting. So total cash flow in GBP. And that would be the addition of the cash flow in GBP, all those adjustment that we made now comes handy now. Yes. All the way down. All the way. So which means we have 3.13, 3.94, 18.24, 18.48, 19.03, 3.44, and negative 0.56 in year 6. So those are the cash flows. Now we need to discount. So we need to get our discount factor. at what percentage, what discount rate are we using? We need to do that. So let's do working 3 for that. Because in the question, they didn't give us directly. We need to calculate it. I'm sure you've gone through the question and you probably have seen that yourself as well. So the question here gave us some information that we need to use. Here we need to use CAPM for sure. So using CAPM, we know that if we use CAPM, our cost of capital will be equals to risk-free rate plus beta into bracket the market return minus the risk-free rate. So which they gave us all the information. The risk-free rate was given to be treasury bills at 10%. So that's 10% plus beta. Beta 1.25 was provided, multiplied by the market return, which is 18% as given, minus risk-free rate again at 10%. So with that, we know that our discount factor is 20%. So which means we need to be discounting at 20%. So use the discount factor at 20% or use your Excel. So NPV of future cash flow is equals to NPV 20% is the discount rate, then all the future cash flows discounted, then the NPV, final NPV will be the addition of the current cash flow that we have, which is year 0, plus the PV of the future cash flows, and that's a positive 1.43. And this is exactly what we are looking for, because the question said we should evaluate the proposed investment, right, in France and recommend what investment decision should be made by Gull. So as we can see, it's positive $1.43 million for Gull Co. And in that case, they should go ahead and do the investment. That'll be it for this question. Stay tuned for the next one. Slightly more difficult. The next question I'm going to be looking at is a full exam question. And please don't miss out on it. Stay tuned. Let's keep going.